Welcome back to Stocks. The numbers quick earnings update here for STEM Incorporated, ticker symbol STEM, listed here on the New York. Stock dropped about 6 cents today, down 11% going into the earnings, sub 50 cents. We can see after hours we're down about 4 1/3 cents, an additional 9% on, of course, some light numbers coming in. And I said in my update last night, I said that it was kind of a toss-up, right? Because we had the little restructuring, the reshuffling of some insiders over there, and we didn't know if it was immediately going to be impactful or if we were probably going to start seeing kind of like this positive snowball effect going into next quarter, which again would be roughly 3 months from today's earnings report. So we're looking at the end of January, early February. So of course, right now, quick heads up, a little underwhelming in the numbers on this report. Some slight positives to hang on to. They do mention certain things that we just looked at, like the gross margin percentage ticking up slightly. And it seems like they're focusing more on the software side as opposed to the actual hardware side with the batteries. And, they incurred a loss. I think it was like 104 million. And right now, basically what's going on is, as you see, we just updated here, and we had a big miss on the EPS side here, reporting a big loss. They say supposedly it was one-time loss, again, of about 104 million. And they they lose 91 cents a share on estimates of a loss of 20.7 cents. So very big miss there. Revenue, of course, comes in light again. Estimates 39.7 million. The company reports 29.3 million. And it's just very unfortunate again, which is why I say I believe they have about a 180-day window. And again, we can check this out, but I believe it's a 180-day window for the stock to get back up to that dollar plus range organically and trade there, I believe, for about like 10 days. And that would kind of lift the compliance from the exchange. And that would kind of potentially put on hold, at least for the time, of the potential reverse stock split that, of course, everyone is fearing. And that's why I'm saying now this earnings report was going to be a little bit of a toss-up. They ended up missing. But that's why I said, in my opinion, next quarter, I think, is going to be truthfully the make or break report for STEM. Because supposedly, again, like we just said, was it incompetence? Did you have some wrong people in the right places? Okay, fine. Now you're moving everything around. You're trying to focus on your large-scale projects with higher profitability as opposed to a bunch of smaller projects that apparently you're unable to bang out on the, recorded time frame. So they're trying to make it work. But also, in my opinion, I also feel like they're trying to pump up the profitability while they know that the revenue is going to be suffering, right? So we have another one of those situations where moving forward, we're trying to make, some margins and some profitability percentages seem a little bit better than they are, while at the same time, we're just completely missing the mark on the revenue. And even if we look right now at what was supposedly forecasted for next quarter, as we see 39.7, they missed again. That marks the 5th quarter in a row that this company has now missed on revenue. And supposedly to close out the year, look at this. We were expecting over 100 million to come in for Q4. Now, the company supposedly guided for like 50, 60 million, I think. And we'll get to that in a second. But again, we're just completely missing the mark. And that's why, unfortunately, because it's been in free fall mode, again, we chunked down here at sub $1. This was back in August. So this is why technically they do still have time. But right now you can see stock down to 42.5 cents. And I mentioned that if we stay in this range from last earnings report, if we immediately drop down, you're looking at maybe around 35 cents. And then who knows what can happen over the following couple of days if they want to break it below the support trend line and bring it even lower. Apparently their assets got adjusted now on the balance sheet, so now the numbers are thrown out of whack, so they no longer look, in my opinion, as attractive as they did, to where back here we can say, yeah, the company's missing earnings and they might drop down, but they have assets outweighing liabilities, and on paper, you can say the stock is worth more, so they can't completely beat it up. And unfortunately, we're kind of getting a little bit of a different story now coming out. So let's get into it. So right here, we can see STEMC's Q4 revenue range 45 to 65 million, which is essentially, even at the top end of the range, that's about half of what was originally forecasted. So now for the full year, they're expecting, I think, around like 130 million or something to close out the year. It's just very underwhelming right now, and it's just very unfortunate. These are just quick updates. All right, let's get into the actual, the actual report. Revenue 29.3 million, down from 133.7 million this time last year. Reflects 5.6 million and 37.4 million reductions in revenue, respectively, due to revised negotiated valuations of assets under certain hardware price guarantees entered into 2022 and 2023. We heard about that as well a couple of quarters ago, the fact that apparently they didn't live up to their expectations or complete the projects in the given timeline, so now they were held liable for like the difference. So that's why, in my opinion, we saw that huge chunk down last quarter. And of course, it's just continuing. Lower revenue in the quarter also reflects reduced battery hardware sales, partially offset by growth in software and services revenue. So I appreciate the fact they're trying to make the shift from hardware to software. The problem is it's taking too long. And even though they mention the slight upticks here in the contracted annual recurring revenue, it's just not enough. It's not enough to outpace the loss that they're seeing in hardware revenue. And of course, it's not enough to come even close, really, to analyst expectations. They're consistently missing the mark by 30, 40, 50%, which of course is not a drop in the bucket. A company like this, that's why I said, in my opinion, estimates were like 39 million. If they brought in maybe like 35, 36 million, maybe they'd have a little bit of a leg to stand on, right? The changes you made may be working, and perhaps next quarter you might actually be able to meet or beat analyst expectations. But I don't know. It really does seem like a toss-up here. GAAP gross profit of 6.2 million, up from a loss of 20 million roughly in Q3 of 23. See what I mean? That they're trying to raise the profit while watching the revenue dwindle down, which unfortunately kind of also puts them in the realm of kind of like that GameStop situation, right? It's like a company that seems to be losing popularity, if you will. It's a company that, for the most part, consistently misses on revenue. But what did they say? Oh, we're making some moves and we're trying to beef up the profitability side. So now the EPS looks healthy, but the business itself keeps dwindling, losing market share, missing on revenue. And that's why I feel like we have a very similar situation here with STEM now. We're trying to, pump up our margins. They spoke about potentially going positive operating cash flow, while at the same time just completely missing the mark consistently on revenue. So kind of trying to put lipstick on a pig right now, if you will. And in my opinion, that this is why, if the stock comes back down towards the lows of 30 and a third cents, that's why it dropped back down here to this trend line here of about 35 cents. And then the stock hangs out here, maybe a little bit of momentum going into next quarter. And then that is why I say that quarter is probably going to be make or break, especially now with the adjusted drop in assets on the balance sheet, because now the company, even in the fundamentals, doesn't really have a leg to stand on anymore. So unfortunately, if we fast forward 3 months from now, let's just say hypothetically the stock stays flat for the next 3 months, because everyone's waiting now for this quarter, right? If they happen to miss this quarter as well, in my opinion, I think the stock is done. I think the company is done. The stock, obviously, is probably going to have to enact that reverse stock split, which, as we know, usually drops significantly after, even going into the reverse stock split and after, the stock continues to drop more times than not. So that's why, in my opinion, this is going to be the make or break quarter. And I was looking for last quarter and this quarter, and like I said, the company supposedly said they made some moves on the inside. They're trying to focus on software, not hardware. So you try to give them the benefit of the doubt, but they are just unable to deliver here. GAAP gross profit, non-GAAP gross profit 16.2 million, down from 21.4, reflecting lower battery hardware revenue. GAAP gross margin 21%, up from minus 15%. Like we were saying yesterday, you know, we have some silver lining on this very dark cloud, but it just really seems like the negatives are outweighing the positives. Non-GAAP gross margin 46%, up from 12%, reflecting a higher percentage of software and services revenue. So again, it's just unfortunate, because if you did want to make this shift, as we see now, of course it's all hindsight, but even business sense, if you did want to make this shift from hardware to software, because whatever, it's a quicker turnover, it's easier for you, you have higher profit margins in that segment, well, then this sort of change and transition should have been implemented probably a year and a half, 2 years ago. See, that's the problem. That's what's grinding my gears right now. Net loss 148.3 million versus net loss of 77 million, essentially doubling that this time last year, which includes 104.1 million of bad debt expense associated with impairment of accounts receivable related to customer contracts that provide a parent company guarantee. So that's what we were talking about a couple of months back. The company basically was held liable for, I guess you can say, just not completely holding up their end of the deal, and now they were obviously held liable for that 100+ million that they had to take on the chin, so to speak. Adjusted EBITDA of a loss of 3.5 million versus a loss of 900,000 in Q3 of 23. Excuse me. Operating cash flow of a loss of minus 9.4 million versus a loss of 4 million. Ended Q3 with 75 million in cash versus 89 million at the end of Q2. Bookings 29.1 million versus 676.4 million in Q3 last year, driven primarily by lower battery hardware resale bookings. Contracted backlog of 1.5 billion, down 17% from the end of Q3 23 and down 2% from last quarter. So one of the few things that they try to tout that is always going up is now slightly down quarter over quarter. Contracted storage AUM, assets under management, of 6 gigawatt hours, up 20% from the end of Q3 23 and up 3% from last quarter. Solar monitoring AUM of 28.5 gigawatts, up 8% from the end of Q3 23, up 6%. Contracted annual recurring revenue, CARR, of 92.3 million, up 5% from the end of this quarter last year and up 2% from the end of last quarter. So this is why, again, like, this is actually a very good sign. The problem is, again, this transition to the software side to generate this recurring revenue and slowly seeing the step ups and kind of that, again, I know we use the same terminology, but now you're starting to see like that consistent snowball effect, right? The CARR is up pretty much consistently from really any given quarter as of late, from that time last year, the quarter before, right? So that's why, again, we have a couple of fundamentals moving in the right direction. But the problem is, in my opinion, this transition should have taken place 18 to 24 months ago, and this number would be up even conservatively, 120, 140 million, and you'd be able now, potentially, even on the pullback of these analyst expectations on the revenue side, you'd at least be able to come close to meeting or even beating these estimates. So the problem is now, unfortunately, like we said, this company seems to be behind schedule. So now anything that we thought was going to happen last quarter, this quarter, next quarter, is probably not going to happen for an additional 2, 3, 4 quarters down the road. Which is why I'm saying, again, 3 months from now, unless we get a random surprise and they're really able to turn this whole situation around, chances are the stock is going to stay down, potentially go even lower into the 20s and the teen cent range, and then they're probably going to enact a reverse stock split, in my opinion. Quote, we reported another strong quarter of growth in annual recurring revenue. Wasn't that strong. Driven by continued adoption of our industry-leading software. Yeah, it's so industry-leading that you're not making revenue. Revenue was down significantly due to lower hardware revenue in the quarter. We have begun to implement our new strategy that we announced in early October, which we expect to drive more predictable, scalable growth in software and services revenue and improve profitability in the long term. Like I said, this could be a situation where we completely beat it up. We bottom it out. Again, they're maybe 2, 3, 4 quarters behind schedule. So we might see a reverse stock split. Then the stock does, 1 for 20 reverse split or whatever. So it chunks back up to a few dollars and then it sells off after the split, drops all the way back down to 50 cents again. And then all of a sudden, 3, 4 quarters from now, they're actually able to start turning in that revenue, beating expectations, and then we're on the up and up. So it's really difficult to try to know what a company is capable of because we can only control the controllables, right? That's out of our control, how this company is being run. So again, even though it does seem like extremely negative, I also like to remind everyone that one of our favorite stocks on this channel that has been growing nicely after it bottomed out is Fubo. Fubo, if you go back to the chart, did go through reverse stock split. Completely bottomed out, got beaten up down to $1, sub $1. Then all of a sudden, they started to get the losses in check. They started to come in, again, more narrow losses than Wall Street was expecting. The platform started to gain momentum. The advertising was better than their peers. And the stock now is kind of on the up and up, continuing to beat estimates consistently. Right? So we can see that after a reverse stock split and a company really gets beaten up, they do have the ability to find that bottom, fix the wrongs, and get back on track. It is possible. The problem, though, is I think that sports streaming may be a little bit more favorable than energy storage and everything else that STEM is kind of trying to do. And I appreciate the shift of, again, the contracted annual recurring revenue kind of slowly inching up. But again, this is something that I feel should have been done a while ago. And while these little tick-ups are nice, the current state of the business, instead of 2%, they needed to see like 12%. Right? Up 5% from this time last year. It should be up like 15% from this time last year. So I'm not exactly sure. Again, I'm not on the inside, so I'm not sure if I should blame management, if I should blame sales teams, right? Incompetence. The person in the right place didn't have the knowledge. I have no idea what the major mistakes are behind the curtain. But this company, unfortunately, is probably going to continue to struggle. And I know, again, they're touting their strong annual recurring revenue. Revenue down. We have begun to implement, new strategy. Quote, sequential growth in software and services revenue drove strong GAAP gross margins to 21% and record non-GAAP gross margins of 46% in the third quarter. Doesn't mean anything. Quote, revenue was negatively impacted by a $5.6 million adjustment tied to an updated valuation of certain hardware contract guarantees that we issued in 22 and early 23. Our bad debt expense increased sequentially by $104 million roughly in the quarter due to an impairment of accounts receivables related to certain customer contracts that provide a parent company guarantee. See, that's what I mean. If you're going to put your money where your mouth is and back it with your company, in your current state, you can't have any mistakes. There can't be an issue. And of course, I know it's easy to say, well, it's easy to say. You want everything to go swimmingly. Yeah, of course. But again, at the same time, you can probably appreciate what I'm saying, right? If we got a report like this, hypothetically, from a more established company, then we can say, okay, they had a rough quarter, they dropped the ball, stocks down, whatever, 10% after earnings. It's probably going to slowly inch up, and next quarter they'll probably beat. Next quarter they'll get back on track. And unfortunately, you just really don't have much optimism to hang on to here with STEM Inc. With the adjustments made this quarter, we have reduced the value of all relevant assets. Yeah, great. Do not expect further negative impact. We are adjusting our full year 24 guidance for several key metrics to account for our latest financial results. Yeah. We are also taking action to right-size our operating costs and conserve cash. We are confident that the changes we are making will position the company to drive faster, more predictable growth in high-margin revenue streams and improve profitability in the long term. Right? This is what I mean. We're showing the weighted concern for the profitability, not necessarily for the revenue. And I appreciate the fact, again, they're saying the CARR is, consistently increasing and it's going to get better. Like, yeah, it might be too little too late. So we can see most of these numbers down for the most part year over year, except, of course, the gross margin percentages. Bookings down big, backlog down. Again, contracted storage, AUM, solar monitoring, AUM, both actually up year over year. CARR increasing again. Revenue decreased 78%. Year over year, lower revenue reflects significantly reduced battery hardware sales. It's just very unfortunate. It really is. Non-GAAP gross profit, 16 million versus 21 million in the third quarter last year. 75 million in cash. Backlog down. Okay. Yeah, new strategy. Like I said, it's just unfortunate. It might be too little too late. And it just bothers me that a lot of these businesses really, excuse my language, but in my opinion, it really seems like they come out of the gate, they get as much as they can, they don't give a shit about anyone else, like screw the timeline, screw what we said, we were going to focus on hardware, now we're shifting to software, oh yeah, by the way, the CEO, the whole time that guy was a schmuck, so now we got to get him out of there, the CFO didn't know what he was doing, we had to promote someone else to the position. That other guy, Patel, right, he was in a, marketing, investment strategy role, whatever it was, they just completely dissolved the role. This is what I mean. So the whole time now, you can make an argument for the last 4 years that everyone was incompetent, you were doing excess cash burning, you were paying somebody for a position that apparently you no longer need now 4 years later. You were touting your hardware and your massive growing backlog, but now you're shifting to software. I don't know. In my opinion, I think the class action suits are coming in. But we have some updated outlooks here. And we can see revenue, look, 200 to 270 million, updated essentially half that now, 135 to 155. And in my opinion, they're probably going to miss that mark. Because as we see, based on what they reported so far, we have 25 in Q1, 34 Q2, just brought in 29. So we're at, what's that, 59 million, 70, 88 million. And if they bring in 50, that'll be 138 million. So yeah, that would actually be in the range. However, we just had this similar situation. I mean, they literally guided for this quarter between 30 and 50 million. So analysts picked the middle of the road, 39.7 million. And they posted below the bottom of their guided range of 29 million, right? They said 30 to 50. So that's what I mean. Now they're saying, 45 to 65, and we're going to do 135 to 155 million. But we probably can assume that if you're saying the low range of 45, that means you're going to bring in like 32 and completely miss that mark again. And that's going to be another revenue miss in a row, which is going to be, 6 quarters now in a row. And then, of course, that'll end up missing the entire fiscal year projection. So it's really just unfortunate. Like I said, in my opinion, I may have gotten a little blindsided seeing the growing backlog and just kind of maybe tried to convince myself that even if the company misses earnings for the next 1 or 2 quarters, it's not a big deal because the revenue is going to start chunking in like an animal, and then this stock is going to start skyrocketing. And it's just unfortunate because, again, a situation like this, I know they immediately tried to do this transition, which is why, I was hoping, of course, for big numbers, but we really need this company to hit a home run. We can't have any more of these base hits or, laying down bunts, so to speak, trying to beat out, a little baseball analogy for you, trying to beat out the throw to first. But, again, 45, 65 million, like this company has to report like 75, 78 million, completely blow that estimate out of the water. They have to show that there's value here in this business, right? That's the way I'm personally looking at it. This is not like a Tesla, where we're already kind of established. We built up, billions. We're popular. We happen to come in light on earnings 1, 2, 3 quarters in a row, but investors don't jump ship because they have full faith in Elon Musk. And they also feel that 2, 3 years from now, Tesla will be doing even bigger and better things. So they don't even care about the drops now. They're just still accumulating shares, and they're very confident for the long-term growth. And that's what I mean. Like you can't interpret this miss and these inconsistencies the same way as compared to a larger, more established company already. Yeah, GAAP gross margin percentage, above expectations. Okay. Adjusted EBITDA loss was 20 to 30 million. This is millions, right? Yeah, millions. Now we're looking for a loss of 30 to 45 million. So there you go. So the EBITDA now that moved up about 50%. Booking 600 million to 1.1 billion. We're now expecting bookings of 100 to 500 million. So we again basically cut that number in half. CARR at the year end, we were looking for 100 to 110 million. This supposedly their bread and butter that they're focusing on is now guided lower, 90 to 100 million now. And we can see operating cash flow, we were looking for greater than 15 million. Now we're looking for flat to a loss of 30 million. So the initial main pumped positive catalyst of positive operating cash flow to close out the year is now off the table. So this is why right now stock, again, dropping down, holding this low 40, and they'll probably bring it down here to 35, 36 cents. But I don't know. In my opinion, it might break even lower. That's what I mean. You might see a flash crash through that bottom support trend line that we drew out since last earnings report. And you may really just see a chunk down to like 17 cents, 14 cents. It is possible. Subject to risk. They're mentioning the Gaza Strip. I don't even want to hear it. I don't even want to hear it. Now you're reaching. But that just might be a generalized statement. I don't even care. I don't even want to read it. Conference call. Who cares? They're going to say, oh, the backlog's healthy and everything's looking all right. Right? Because they've been saying that every quarter for years, and the stock's down 99%. Cash is down. Accounts receivable down. Inventory up. Deferred cost down. Total current assets, you can see, going from 472 million. 472,000 in thousands. Yeah, okay. So 472 million, my apologies. Down to 227 million. So that essentially got cut in half. Energy storage systems down. So total assets, as we see right now, went from about 1.3 billion down to $500 million, which is an issue. All right, we look at liabilities, accounts payable down, accrued liabilities down, payroll down, financing obligation up. Total current liabilities technically down. Okay. Yep, of course we have sirens going by. Literally every time I make a video, there's a fire, there's an emergency. But, okay, we're reading. Accumulated deficit. Chunking up to over 1.5 billion. Total STEM shareholders equity minus 344 million, was positive 426 million. So, with all of these numbers, again, now getting adjusted and taking huge hits, in my opinion, we can no longer look at the actual fundamentals, because the fundamentals are horrendous and may lead us to, again, a reverse stock split or a stock and a company going out of business and going to zero. So in the numbers, in my opinion, stock now looks horrendous. So this is why I'm saying they supposedly did this transition, moving into software. We're going to turn it around. I'm telling you, in my opinion, they have until next quarter. And if they drop the ball again, sayonara. Revenue's down. But again, they're saying profit is up. So they're more profitable on significantly less revenue. That's what I mean. That can only keep you afloat for an instant. It's going to be very short-lived, even if you get a little bit of momentum coming into your stock. Oh, this is rough. Accounts receivable, basically reversed. Loss of 67 million up to 106 million. It's just not enough. Investing. Cash down. Oh, man. Oh, man. Yeah, this is just very unfortunate. This really is very unfortunate. Because again, we saw the growing backlog, and they were kind of making it seem like it's everything's fine and it's going to get better and you have nothing to worry about. And I just laugh going back to, again, we started looking at the stock, it was like $3 and change or something. Now you're down here at 40 cents. So just think of how many quarters you're sitting there BSing everybody. Like, oh yeah, everything's going to be fine. You wait and see. Backlog's growing. We're out here. We're going to try to change the world. That's why I always say, again, and I know it's all hindsight, but this is a perfect example of a company getting listed public at an overvaluation. And that's why I say, especially with these newer stocks, sometimes you're better off just taking a step back, giving it some time, and actually waiting to see, is the company consistently beating on revenue? Are analysts beefing up the price targets? Are they coming in ahead of schedule? Are they increasing their guidance? Right? You have to wait and see. And the issue here with STEM, unfortunately, again, and I know I got a lot of slack over the last 2 years when I mentioned this with multiple stocks that you guys asked me to look at. But giving all young people tens of thousands of dollars in free stimulus money was the worst thing for the market, hands down. Because everyone piled into fuel cell stocks, battery stocks, EV companies, anything with electric, anything with solar, anything, all the EV stocks. Rivian, overvalued right out of the gate. Lordstown Motors, RIDE, no longer even public, went bankrupt. That's what I mean. And that's why I literally said we took stocks from a few dollars and pumped them up to like $100 a share. And now they've been in a downtrend for the last 4 years because they had no business going that high to begin with. And the whole time, people disliking the video. Oh, you don't know anything about the company. You should do something else. Join a different industry. Go work at McDonald's. And now what? And now what? They're all down tremendously. We're not talking 10, 20, 30% haircut. These stocks are down 80, 90, 99% from these highs. Even QS as of late. Perfect example. That video got a couple of dislikes. Stock ran up to $130. Now it's $6. $6. Are you kidding me? But that's what I mean. When people can't back it up in the numbers, because like we always say, men lie, women lie, numbers do not lie. So that's why when I look at the numbers, and I personally come to a conclusion that I think something is overvalued, unless you're going to mention numbers that are coming in the future that are going to readjust the valuation, then you coming back to me and saying, oh, you don't understand the company, you don't understand the vibe in the sector, like all of that is nonsense. Those are generalized, vague statements to kind of keep you in denial and convince yourself that you made the right choice. And granted, of course, I can always be wrong. Again, something like ASTS, perfect example. I thought it would pull back. It kept climbing up, right? But they're all not going to do that. So that's why just, looking on stock twits and turning back to me and saying, you don't know the company. It's like, first of all, yeah, I never claimed to be an expert, and I don't know every single iota about STEM Inc. I'm going to be 100% honest with that right now. But again, the numbers do not lie. So whether I know every facet about the business or not, if they keep missing revenue estimates by 30 to 50%, who gives a shit? Because at the end of the day, stock's going to go down, the company's suffering. So that's why I say sometimes you got to cut through all the nonsense, and you just got to use simple logic and common sense sometimes with a lot of these situations. But STEM just consistently disappointing, and that's why I'm saying I believe the window is 180 days for them to get the stock back up to above $1. And technically, they do still have time before they might be forced to do a reverse stock split. But in the current state of the business, I just don't know if that annual recurring revenue will increase enough. I don't know if 3%, 5% increases in that CARR and software revenue quarter over quarter, year over year, is enough to really convince people to jump back into the stock and see value here. And again, we're guiding what, 45, 50 million for next quarter. It should have been 124 million, estimates are almost up to. So that's what I mean. This company may need several quarters to readjust themselves, and that's why I feel like they might be due for a reverse stock split. And I know a lot of people in the comments were saying, hey, listen, it happens. I live and I learn from the mistake. I'm going down with the ship because anything can happen. And if not, again, good learning experience. I'll know what not to look for next time. And that's why we say you have to learn from these mistakes. And being foolish is making a mistake and not learning from it and just trying to repeat it. So that's why now a company like STEM, perfect example of waiting for the company to actually deliver and show you proof in the pudding, proof in the numbers, before maybe you try to step in and kind of predict that this is the bottom of the bottom and now it's going to explode back from $1 to $3. Of course, I was hoping for that too, but unfortunately the company just really keeps dropping the ball. They have no idea what they're doing, in my opinion. That's how I'm looking at it. But RSI here, again, we're moving, of course, after hours, so these numbers are changing as we speak. But on the close, RSI 46, probably going to drop down to 30, sub 30 now, immediately, probably. We came right back down to the moving average here, 50-day, 49 cents, closed at 48. Stock down to 41, after hours 43.4. That's what I mean, right? It was underwhelming, but again, at the same time, we can't completely... I'm pissed off, right? I'm a little salty right now. So I want to say we can't completely tank the company, but in my opinion, I would. But, they're trying to keep them up. And again, right now down at 43, bottom trend line about 35, 36. So in my opinion, that's probably where it's going to start to go over the next day or two. And bottom Bollinger Band 41, it's probably going to break that. MACD was curling, starting to cross to the downside. And a nice surprise here, or just some positive catalyst to hang on to, would have been a phenomenal explosion, potentially gap filling here back to 91 cents. But, of course, the company does what it does best, which is miss earnings. And stock is down. MACD probably going to cross now bearish to the downside, which is going to lead to the sell-off to the low 30-cent range, in my opinion. RSI on the weekly was down here at 34. Because again, nobody sees any urgency, any hype behind this company, other than the fact that it got completely beaten up, and if they happen to beat earnings, then the stock will explode. And I understand some of us have a little bit of excess liquidity, and we can roll the dice on situations like this, take a shot. Ah, damn, it didn't work out. Yeah, but if it did, the returns would have been massive. I can appreciate that type of mentality, but again, in all seriousness, if we're talking about, smaller term traders, investors, a lot of you young people who might have just gotten started over the last couple of years, if you built up an account of, a couple of $1,000, you're trying to throw in a few dollars, every week or every month when you have some excess, and you're now trying to build a portfolio. As boring as it sounds, and as painful as it is to see other people's options returns, in all seriousness, when you're starting out, you should be looking for, solid mutual funds, maybe some income ETFs, or even if you want to buy individual stocks, you're starting to see now that you should more than likely invest into companies that are already fundamentally sound, that either have continued growth on the horizon or are just straight up undervalued, and you're kind of quote unquote guaranteed some future growth, right? And we've looked at companies like Rolls-Royce, Soundhound, again, a little bit of a speculative situation, but the stock is up. A lot of the other brand name companies, of course, you have your Teslas, but again, we looked at like IBM, perfect example. Something like a Verizon, right? It got beaten up, dropped down into the 30s. Over time, it was probably going to be fine. So anyone who bought that is up, and they're collecting dividends. PM, I've spoken about time and time again. It's a stock that's flying underneath the radar. I do videos on PM. It gets 50, 60 views. It breaks my heart. Because again, you guys literally saw the stock go from sub 90 to new highs here of 135 or whatever it hit recently. So that's why when you're first starting out, when you're trying to build your portfolio, you technically should be looking for companies that are more than not consistently beating earnings estimates, increasing guidance, looking for bigger and better things down the road. A lot of your tech companies, but again, something like something like STEM, just completely missing the mark here. In the weekly, bottom Bollinger Band, 5 cents. It is possible. And we can see we're nowhere near. We're kind of in no man's land here. Let's look at the pivot points out of curiosity, actually. I'll let you go, because if I keep going, I'm just going to get more and more upset. And we can see also bottom support level here on the weekly, 35 cents, essentially right at that bottom support trend line that we drew out. So that's why, in my opinion, that's probably where the stock is going to go. In the daily, in the daily pivot point, 41 cents. Stock still sitting at 43 cents. Not much going on. Maybe we're waiting for the conference call going on now. I don't know. I don't think much is going to be said. But 35 cents, in my opinion, is the next mark. And then if it breaks, yeah, you could see 24 cents. Absolutely. Absolutely. Because even as of last quarter, if we look at the numbers, debt up to about 600 million, cash now down to like 70 million, but even if we say it's 90 million, it doesn't matter. See here, we have assets outweighing liabilities. That's really no longer the case, apparently. And we can see that even as of last quarter, we have liabilities now outweighing the assets, because they had, what was it, the one-time payment of 540 million or whatever it was. So now the company's out like $650 million in asset value just over the last 6 months, which of course is not a good sign. Equity negative, book value drops negative, was slowly dwindling down, goes from 230 to minus $1.25. So that's what I mean. That's why even chunking the stock down to like 7 cents, believe it or not, is justified in the numbers. So I want everyone to be aware of that. And if we look at the quote-unquote fair value, I mean, it's negative. Even if we go by these numbers, right? 600 million debt. Well, even if we call it 100 million cash, you're still at minus $500 million, minus 700 million. And then if we look at last year, 460, but it cost 140, so that's plus 320. So you're at minus like 300 million, quote unquote fair value. Market cap 78 million. So that's why, unfortunately, something like this, you may see a market cap dwindle down to like 18 million or something wild like that. It is possible. Company hasn't given us anything positive in about 18 months. And they're just dropping the ball. They really are. Over the years, they're missing revenue marks. Somehow for 23, they posted a more narrow than expected loss, but chances are 24 is going to miss that mark. I do not see this explosion in revenue happening. But that's just me. And again, these estimates got cut by like 60% now. We're looking for 50 million roughly. And even something like this, asking the company to bring in almost 60 million. I don't know if they can do it. I really don't think they can do it. We went from 60, 90 over 100 million. And again, yeah, we missed the mark, but look at how the estimates chunked up. So we did what we could. And now we're just seemingly slowly going out of business. And that's why, again, they want to do the transition. Oh, the revenue was chunking in from the battery hardware, but we're shifting away from that and we're moving into software. Okay, well now your revenue is going to take a hit for the next year and a half, 2 years. People are going to forget about you. You're going to go out of the spotlight. Your fundamentals are now flipped on their head, and now everything's negative. So this is why, again, it might be a Fubo situation where we continue to go down, we reverse stock split, people forget about it, and then they eventually bottom out and maybe are able to show some positivity. But as of right now, in my my opinion, as of last quarter, this is just another dismal report, which unfortunately has now become the norm for STEM Inc. But that's pretty much it, and I'll end it there. So once again, this is Stocks by the Numbers. I want to thank you for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually pretty quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But of course, more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, they are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thank you for your time. Have a good day.